Katie says, I have a question about my mortgage. I have a 30-year mortgage at a 2.8% interest rate. I never thought much about it until I started listening to your podcast and exploring more ways I could be financially responsible. I did a little bit more research about how mortgage loans are paid back, and I'm seeing that now in the first half of my 30-year mortgage, the majority of my monthly payment is going to go toward interest and not much toward principal. Would it be stupid of me to consider taking out a HELOC for the amount of my mortgage, use it to pay off my mortgage, and then use the money I was paying my mortgage off with to now pay the HELOC off? Correct me if I'm wrong, but I believe the monthly payments I'll be spending toward the HELOC, more of that will go toward the principal than the interest, which is the opposite of my mortgage. Is that a good idea? I'm honestly not sure what I should do in this situation.
I think it's a terrible idea. You have to look at the fact of right now you have 2.8% interest. The HELOC's going to be 7, 7.5, 8. I don't know exactly what they are at the time of filming. And you have to also understand something is it doesn't work that way. The HELOC is only going to approve you for a certain specified amount of the total equity you have in the property. That's what you're going to be able to borrow. So unless this house, you've already paid down 60, 70, 80% of it, you wouldn't be able to get enough in the HELOC anyway. So I think your thinking makes sense, but the way it would play out simply does not work. So Katie, I don't like this idea at all. For everyone listening, I'm okay with HELOCs. If you believe that you have all this equity in a home, say it's your primary home, and you can use that for a really valid reason. Maybe you're going to renovate your business. Maybe you're going to put an ADU in the backyard of your property and the numbers play out there where it's going to be profitable for you for the long term. But just to try and get a HELOC to pay off the current mortgage for a much higher interest rate, the math just doesn't work.
I'm right there with you. 2.8% interest on a 30-year mortgage. I would be big chillin'. I would be making my normal payments. I mean, you're probably over here, depending on how much you borrowed, like on an annualized basis, maybe paying $6,000, $7,000, $8,000 a year in interest, which really isn't all that much. I mean, the house I'm in right now and filming inside of, I bought for about $400,000, and I have a 6.5% interest rate on this mortgage. And according to my tax payments, I paid like $23,000 in interest last year, just like on those mortgage payments, right? So like you paying $6, $7, or $8,000 is pretty cool at that 2.8% interest rate. Again, when we talk about interest rates and why they're important to consider when it comes to investing versus paying off debt, things of that nature, is because we know over a long period of time, the S&P 500, the NASDAQ, the Dow Jones, right, the ETFs and index funds we talk about go up and to the right by 8, 9, 10% over a long period of time, but that happens every single year on average. And so what you're essentially doing is taking money that you could have invested at this 8, 9, or 10% in these index funds and ETFs, and instead putting it to pay off a 2.8% interest rate. So you're making 2.8% on your money because that's interest you're not paying, but the opportunity cost of that was not making 8, 9, or 10% somewhere else on your money. So again, we always talk about like arbitrage and making sure that our money is working hard for us and things of that nature. You can't out-invest high-interest debt. We say that all the time because if you're paying 30% interest, then yeah, you want to go pay off that 30% interest, but you're only paying 2.8%. So if I were you, Katie, I hear what you're saying about like the amortization schedule of your mortgage. It's probably something you just learned and it's freaking you out. It's life, unfortunately, but I would just keep the mortgage and rock and roll.
100% agree with what you guys are saying. I bought my house back in 2021, about $400K. 2.99. I've told my wife we're not moving because this mortgage rate is like an asset essentially. You can't get that anymore, and the amount of interest you're paying now compared to what you would have to pay if you buy a house today can't even compare. So yeah, I mean the mortgage, I don't know if the asset is the right word, but I kind of treat it like an asset. It's an asset having that low of an interest rate, and then you can use the money saved over to invest in things like the S&P 500 or other things because you're going to get a higher yield. Even in bonds, you can put the money in bonds and you're going to get a higher yield.
I want to illustrate that a minute because I think it is one of the most important things in building wealth for people to understand. There's a lot of people out there that are in financial education that are telling you to have no debt, debt is bad, all these terrible things. But what you have to understand that Austin and Zaid alluded to is that think of it this way in very simple terms. If you can borrow money for 3% and you can make 10, 12, 15% with the money, all of that arbitrage, that upside potential goes to you, not somebody else. And that is why the wealthiest people on earth have payments on their homes, payments on their jets, payments on their yachts, and everything else, because they know that if they borrow cheap and use their money elsewhere where they're going to make a lot more with it, it's going to add to their balance sheet, not someone else's. So I hope that helps everyone listening why we talk about this, and that arbitrage is so important, that the positive arbitrage is going into your account, not someone else's.